It's the perfect time to make your money work for you. And we're here to help new investors in learning the basics. You'll need a fundamental understanding of how to invest your money properly before putting your hard-earned cash into an investment strategy. In this video, we'll go over 13 of the most significant principles that can help you make smart investment choices and keep your investments on track. Number 1, the higher the risk, the higher the rate of return. Since no one really wants to lose their hard-earned money, most investors tend to gravitate towards safe investments, which, as we all know, provide the lowest return on investment. These safe investments, however, are less enticing to risk takers who are looking for enormous profits. Instead, they favor riskier investments with potentially enormous upsides like startups and IPOs. You get to decide how to play your cards based on your risk tolerance. Number 2, regression to mean. For some of you, this might sound a bit complex, but it's actually not. It basically means that everything in our world, from average annual rainfall to average return on investments, or ROI, tends to return to its historical averages. The majority of investors examine current returns of an asset class instead of historical trends when examining stocks. They are attempting to anticipate and forecast its future performance by doing this because the regression to mean concept will occur. Stocks that consistently outperform for a few years are likely to underperform during the following years. It is practically impossible for an investment that has traditionally produced low returns, for example, for the last 10 years, to suddenly shift into a major moneymaker. Number 3, diversify your investments. It is one of the best strategies to protect your money and ensure a high return. We all understand that the value of stocks fluctuates constantly based on the condition of the market and national events. For this reason, financial experts frequently suggest that investors diversify their investments. This implies that you can invest in a variety of asset classes, including bonds, stocks, commodities, and other sectors like technology, energy, healthcare, and more. Diversification is your greatest option if you hate losing money because it will protect your investment while also increasing your wealth. By diversifying your portfolio, you help shield against ongoing market volatility, which might easily cause your investments to lose all of their value. This principle guarantees that you will reduce the risks associated with your complete investment. Number 4, adopt a long-term perspective. Without a doubt, trading speculatively in the financial markets can score you a few dollars, but you'll typically lose a great deal of money trying to catch the next big wave. Purchasing an asset at a decent price and watching it increase in value is the actual core and beauty of trading. Warren Buffett claims that long-term investing is one of the most crucial investing principles because short-term trading would only result in lower returns or losses over the long run. This may take some time though. Don't allow greed or fear to influence your choices. Let time run its course. Number 5, investment costs are important. Many individuals fail to pay attention to the small fees they are charged. A modest 1 to 2% fee may not seem like much, but when you do the mathematics, you'll be absolutely shocked at how much money you could lose. There is a belief that companies that demand higher fees have more funds for research and perform better. Research suggests differently, though. Investors that reduce all of their expenses generally outperform others. Number 6, bear a margin of safety. When it comes to investing, pricing and value for your money will always be essential. By doing this, you're essentially buying assets for significantly less than their real value. Occasionally, particularly during a recession, assets will be sold for less than their intrinsic values. An investor can get a terrific bargain by purchasing an asset for less than the market price, since the return on investment is nearly certain. We are all aware that conditions on the financial markets can quickly shift. Multiple things can affect financial markets. Be prepared for anything. Number 7, allocating assets is vital. Returns on investment are dependent on how an investor allocates their portfolio among various asset categories. Many investors fall short in this area because they give their asset allocation plans far too little thought. You are destined to get lower long-term returns if you invested only in assets that were overvalued. The secret is to consistently examine all categories, giving less weight to those that are expensive and more weight to those that are inexpensive. Number 8, the power of compound interest. If you want exponential growth, you need to spend some time learning about compounding. Start by learning how it actually works and how to use it to increase your returns. The way compounding multiplies your money over time is among its most incredibly interesting features. While compounding can be beneficial, it can also be destructive. Instead of regularly extracting profits, keep the money and see how much more you can earn. Number 9, risk management. Nothing valuable in life is free from a certain amount of risk, and investing is no different. Investors use risk management techniques to reduce risk. One of the main culprits that may quickly wipe out your money is portfolio volatility. Investors are continuously seeking to find solutions to this major issue, particularly during bear markets. For those who have no idea, bear markets are those in which share prices are dropping and selling is encouraged. So, you can assure you don't lose any money by managing the risk. Number 10, volatility. You must escape from portfolio volatility while welcoming market volatility. Portfolio volatility can be easily managed, but financial market volatility cannot. However, excellent opportunities are also brought on by market volatility. Be prepared to benefit from them when the moment comes. Be aware of overvalued assets and have the flexibility to transfer your money when the going gets tough. Number 11, take charge of your future. Nobody is going to care as much about your money as you do, so you should be in command of them. Self-investing is a very enticing alternative because of conflicts of interest, fraud, and outrageous fees. Fortunately, fees and other transaction costs have dropped thanks to technology and the internet. Additionally, it offers all the data required to make the best investing decisions. The ability to become a self-directed investor with the least amount of work has never been better than it is right now. See what you can accomplish on your own before focusing on hiring a fund manager or financial expert. How much you'll be able to save on fees and transaction charges will shock you. Number 12, keep your emotions at bay. When you invest, you run the risk of either making very little money, a lot of money, or losing everything. Return rates are determined by the markets, which may or may not work in your favor. Make sure not to let failure get to you and have the will to keep investing your money. Number 13, discover new things and do research constantly. The internet is a source of endless information. Utilize this information to discover new trends, possibilities, and investment avenues. While some of the resources require a minor fee, the majority are free. Continue to follow business news to stay informed, and you'll soon develop your own expertise as an investor. That concludes today's video, which we hope you enjoyed and learned something from. Give it a thumbs up if you liked it, and consider subscribing to the Inlet Financial Coaching channel if you haven't already. Thanks for watching, and we'll see you in the next video.